The S&P 500's massive bull market is coming to an end, according to Goldman Sachs. Let me explain. Goldman Sachs forecasts just a 3% annual return for the next decade, down from 13% from the last decade and down 11% from the average. And there's a couple reasons for this forecast. The first being market concentration. The top 10 largest stocks account for 36% of the entire S&P 500 index, which is at its highest point in 100 years. Mag 7 stocks were responsible for more than half the entire S&P 500 gain last year. Therefore, if these 7 companies don't continue performing, we could see some lagging gains. Number 2 is that valuations are expensive, considering that the CAPE ratio, or the cyclically adjusted PE ratio, sits at 38x, near historic highs, ranking in at the 97th percentile. Reason number 3, companies are unlikely to sustain growth and margins over long periods of time. During the last 40 years, companies were able to consistently generate over 20% revenue growth, but faded sharply over just 10 years. Reason number 4, they expect to see 4 economic contractions in the next decade, up from 2 that we've experienced in the last decade. How do we mitigate this? Well, they forecast a 72% probability that bonds will do better than the S&P 500, and equal weighted indexes could outperform by 2 to 8% annually. Let me know in the comments if you think that this will come true, and if you want to see the stocks that I own that has outperformed the S&P 500 in the last several years, check out the Blossom app or comment the word stock and I'll send it to you directly.